Nuveen's head of equities and fixed income, Saira Malik, says there are opportunities outside of tech anyway. He joins me now with more. It's nice to see you. Welcome to Closing Bell.
Good to see you, Scott.
So where are you looking elsewhere?
Well, Scott, there's been a lot of news thrown at investors this year, but there's been two factors driving the markets, and that is technology and tariffs. So let's start with technology stocks. Basically, when DeepSeek came out with their news, what it told investors was we need to be a little bit concerned about all of the spending that's happened in artificial intelligence and whether we're going to monetize that and what is going to be the returns on that. Just yesterday, NVIDIA reporting a great quarter, but not quite good enough. Investors are used to these huge beats by these tech companies, and we're just not seeing those at this point. So we're looking outside. So areas such as infrastructure. We like a company named NiSource. It's an Indiana-based utility. It is still a little bit of a play on data centers, which is tech-related, but also strong earnings growth, cheap valuation for that company. That's another one. As the U.S. builds more within our own country, I think that's going to be a winner in the utility space.
Because you talk about that, what do you make of what's happening with momentum names right now? For example, a lot of people love Vistra for the exact reason you just talked about, right? AI power, infrastructure, and yet that's a stock, for example, that has been caught in the downdraft of the momentum trade.
Well, I think the momentum trade has been driving the markets for the last couple of years. We had the S&P 500 up over 20% each year, but it was that market cap weighted and the mega cap 7 that really drove the markets higher. So we came into this year with the S&P already at a 20% premium to history. That momentum trade is unwinding. I'm not saying that U.S. technology stocks don't have a lot of growth ahead of them, but so much has become priced in, so much hype around AI and what we can do. And the reality is that we've spent tens of billions of dollars on AI, and we really have not seen significant productivity gains in that space yet. So I think it's time to look outside of the market, and you're seeing that already this year with international markets outperforming U.S. markets. You take a look at Europe, which has a cheaper valuation, more of a cyclical bias. European financials are up over 20% year to date. We like companies over there like NatWest. These are companies that can continue to do well in a period of flat to lower interest rates, strong net interest income. We think financials are a great global play going forward.
Wait, so are you saying that you like international stocks better than U.S. stocks at this point?
Well, if you're looking at year-to-date returns, most investors would be well served to own international stocks. I think this will be a year where international may continue to outperform U.S. stocks. If you look at earnings growth, even though fourth quarter earnings for the S&P 500 wrapping up right now at 12% earnings growth year over year, I think for the year, the S&P could put up about 7% earnings growth. So markets have some upside, but our price target on the S&P 500 for 2025 is about 6,400. Looking outside of the U.S., though, now we have more of a non-tech cyclical play. And I think that given the discounts which European markets entered the year with, which was about a 40% discount to U.S. markets, I think European markets and some Asian markets may actually outperform the U.S. this year.
Interesting. Saira, we'll talk to you soon. Thanks for your time. Saira Malik.